Good day. Today we're going to look at a small exercise that's intended to show you how simple finance actually is. This is the exercise that is part of the third module in the Introduction to Finance series, part of Chapter 2. In Chapter 2 we talk a little bit about the balance sheet, income statement, and cash flow. This problem, getting into business, talks about a situation that Jelle and Yolanda are trying to start a new business selling t-shirts at CAH. Let's see how they're going to make out. I'm going to start with a cash flow, then we're going to work on the income statement, and finally the balance sheet. All of these covering just the first 2 days of their getting into business. So let's get started. As mentioned, we're going to start with the cash flow statement. Cash flow is exactly what it says. It traces the flow of cash into the business and out of the business. Okay? And that's how we set it up. We talk about the cash in, sometimes more formally referred to as sources of cash. And we talk about cash out, which sometimes more formally referred to as uses of cash. Forgot an H. So the first thing that we will account for, although at this stage the order of things isn't all that important, but the first thing that seems to happen in this business is that Jelle and Yolanda each have 25 euros that they're going to contribute to the business. So we typically in a cash flow call that beginning cash, because that's how much money we have to start with. Beginning cash is 50 euros. Next thing that occurs is that they go around and they talk to some of their friends, and they are able to talk them into giving them 25 euros each. So they have 100 euros that they have borrowed. This is money that they intend to pay back with interest at some time in the future. So it's considered a loan as opposed to being part of the ownership. If they gave the 100 euros and wanted to be part owners, then they would become partners and then share in the profits. This way though, it's a loan. So, loan from friends, is 100 euros. This is all money that has come into the business. Now read through the description of the business, and you'll discover the next aspect that brings cash into the business, and it's sale of the shirts. They have sold 15 shirts for $15 each. So sale of shirts with the logo attached is 225 euros. 15 times 15. That's it. That's all of the cash that's come in. So we can now total this. So you talk about a total cash in is 375 euros. All right. Now let's look at the cash that goes out of the business. This is what they have either spent in the business, or if the owners decide to withdraw some money from the business to use for personal purposes, then we also have to take into account repayment of loans is also a use of cash. So there's a number of things that we need to consider, but in this simple 2-day exercise, there's not very much going on. So cash out, what did they use the cash for? They bought shirts. Normally we refer to that as purchases. Purchases of shirts. Was 100 euros. They bought the logos that to the iron-on logos, and they had to buy enough for each shirt, so they were €1 each, and they bought 20 of them. And that's about it for money going out of the business at this stage. We have no instructions that the loan was repaid at this stage, and we also have not made any withdrawals by the owners for their personal. So we can now total cash out. Is 120 euros, and if we subtract the cash in from the cash out, we'll discover that our total cash surplus is $255. Okay, or I knew I was going to do that. 255 euros. And it's common to put a double underline at the very last total, so that the reader knows that this is the end of this particular calculation. Okay, so that's the cash flow. Notice I have not called this profit. I haven't called it a profit. I haven't called it net income. Okay, all this shows is the cash that we have in the bank or in the business box, I suppose, at the end of day 2. So, the next step is to prepare the income statement for these 2 days. This is where we will calculate what the net income has been or is so far. So the income statement is essentially the looking at all of the revenues or sales or things that were sold for the business or as the business operates, and all of the expenses that are incurred in order to earn that revenue. Okay? And that's a very important point. I'll stress it in a minute again. So let's look at revenues first of all. So we have, in terms of revenues, we have sales of shirts, and with the logo attached, so it's 225 euros. Okay. All of these sales were in cash, so the cash sales and the income statement sales are the same. Now we go to expenses. Okay, now, expenses are a little trickier because remember what I mentioned a minute ago, that the expenses are those costs that were incurred in order to earn the sales. So one of the expenses was a shirt expense. Now, we bought 20 shirts, but we only sold 15. So the cost or the expenses that we incurred to earn the revenues represented by the sales of 15 shirts is the cost of 15 shirts. Okay, so we had 75 euros for the 15 shirts that we sold, and in addition to that was the logo expense for 15 shirts also. Okay, so this subtotal of the expenses then is 90 euros. That's all of the expenses so far. This is a partnership, and a partnership cannot claim as an expense the payments, the salaries or wages paid to the owners. So even if they paid something to themselves, it wouldn't show up here. It would show up in cash, but in a partnership like this, the income of the net income is considered to be the all attributed to the two owners. Okay, so we have all of this, and now we can calculate the net income. Okay, so net income is 135 euros, and again a double underline. All right, now with this information we can calculate the balance sheet, which is slightly different. But before we do that, let me reinforce again the difference between net income and cash surplus, or if you like, deficits. So we had 255 euros of cash in the business after day 2, but our net income was, our profit is only 135 euros. Well, only, that's pretty good for 2 days of work. Okay, so the balance sheet, let's go to that, but what I want you to remember are these totals here, because we're going to need those for the balance sheet. So up here I'll just say cash is 255 and net income is 135. All right, now let's get to the balance sheet. Balance sheet, as you know, looks at the assets equal liabilities and equity or capital, or if you like, assets equal claims, and the claims are representing the liabilities and the capital or equity of the owners. So let's pick another Christmas color here. So the balance sheet, we start off always with the assets. Now think of the assets that this business has. We know it has cash, okay? So normally the very first account in a North American style of balance sheet is cash under current asset, but we're not going to worry about that sort of thing just yet. Cash is 255 euros, okay? We also have 5 shirts and logos that we haven't sold yet. That's inventory. So we'll call that inventory here. And inventory is considered anything that you have for sale, this type of inventory. So the value of those shirts is 5 times 6, 30, is that right? 30 euros. All right, any other assets? I think we're good. So we have total assets equal 285 euros. Now liabilities, Liabilities, we have one loan to our from our friends, and we haven't paid anything back yet. So liabilities are 100 euros, and equity, therefore, the partnership equity, in order for this to balance, the partnership equity has to be 185 euros, so that we end up with the 285 euros for the total of liabilities plus equity, or the total claims. Okay? Always has to equal. If not, then we've made some mistake. Now you notice all I did was subtract this. That's the easy route, and if you do everything right, it'll work. If you don't do everything right, it'll give you the wrong answer, and I'll show you how to calculate equity right now. So when you're calculating equity, for the end of a particular period or a point in time, you have to start with the beginning equity. Beginning equity is equal to the 50 euros that the partners had with at the very beginning. They had it in cash, so if we did a beginning balance sheet at that time, it would show there's 50 euros in cash and there's 50 euros of equity. This is before the loan occurred. So the beginning equity is 50 euros. Then you consider any drawings. So you subtract any drawings by the owner. So if they took money out for personal purposes, that's drawings, or sometimes it's called withdrawals. And that is subtracted from the ending equity. Now we look at our cash flow, and that's where you'll find if there have been any drawings, and we find that there have not been. So in this case that's zero, so it doesn't have any effect. The other thing that can happen is that the owners can put in additional money from their savings, or maybe they were given a gift from their parents or something, so they could add that to the equity directly. So whenever the owners contribute outside money to the business, that goes directly into equity, and it's called contributions. So you add that, contributions. In this case, that too is zero. And finally is net income. So you add net income. And in this case, net income was 135 euros. So 135 euros here. Add that up to get ending equity, which is what we're looking for. And you'll notice that this is 185 euros, exactly the same as this. And that's how you do a very simple business, and you lay out the three basic financial statements that are connected with businesses, and it doesn't look very difficult. We're going to make things a little more complicated, but essentially the statements just become longer with more accounts. So thanks very much, and good luck on the assignment, where you're going to tell me what the third day looks like when they sell the rest of the shirts and pay back the loan with 10% interest. Thanks.